the first quarter of this year, the spread of the coronavirus led to an indiscriminate sell-off across most U.S. asset classes and created dislocations in credit markets. However, it is important to note that the volatility in credit was not caused by the onset of a typical recession, but rather a sudden halt in economic activities. In response to the economic downturn, the U.S. Federal Reserve acted aggressively and proactively by cutting rates, unlimited quantitative easing, cutting banks' reserve requirement, and also took unprecedented action to make direct corporate bond purchases. In addition to the Fed action, fiscal responses from the government was also swift, with more than $2 trillion worth of stimulus being rolled out. The impact of these initiatives was immediate. Credit markets have rebounded, new issuances have picked up substantially, and high-yield funds have seen record inflows. Many risk assets continue to rebound through April, and by the first week of May, the Fed has not started any bond purchases yet. Still, the near-term outlook for the global economy continues to evolve, and corporate profitability remains uncertain due to the pandemic. Recent economic reports have been weak, and economic data is unlikely to rebound in the short term. So far, first quarter corporate earnings have come in below expectations, and most companies' outlooks have limited visibility. While the duration and severity of the economic downturn is unknown, the extraordinary monetary and fiscal policy measures have helped stabilize financial markets and are expected to accelerate the recovery when the economy reopens. The three underlying asset classes in income and growth have rebounded from their March low, and their valuations have come in when compared to the beginning of the year. High-yield default is expected to increase, but risk should be concentrated in the most distressed credits within the exploration and production and oilfield equipment and services sub-industries. Overall, high-yield market remains well diversified across many industries. Besides energy, healthcare, telecommunications, cable and satellite TV, and technology are among the top industries in the universe. At April month-end, the high-yield market's price was around 89 cents on the dollar, and spread was at 763 basis points. According to JP Morgan, a spread of 800 basis points has historically led to attractive return opportunities. This backdrop offers a very attractive entry point for long-term investors with significant total return potential given the market's discount to par. For convertibles, we see many convertible bonds have approached their bond floors after the sharp decline in the stock market, which means the market's downside risk should be much more contained going forward. When the underlying equities recover, we believe convertible bonds are well positioned to participate in the upside. Lastly, in the equity sleeve, implied volatilities for many individual stocks remain above average, providing attractive annualized buy-right yield opportunities to help supplement income distribution. At the current market levels, long-term investors would be wise to re-risk their portfolios and consider a range of income-generating strategies that have historically held up well during down markets. Income and growth offer both stock-like returns with moderate downside volatility. It is also important to remind investors not to allow short-term market uncertainty to derail their long-term investment goals. The income and growth strategy continued to maintain a static portfolio allocation despite market environments. The fund's dual objective remains, aiming to provide investors with a consistent monthly income and the potential to participate in capital growth. Before the sell-off in late 2019 and in early 2020, the fund was already reducing exposure to areas that were exhibiting fundamental weakness, especially cyclical issuers, poor relative value, and unattractive convertible bond structures. The fund also took advantage of robust new issuances by rotating into more compelling total return opportunities. The investment team has not made any knee-jerk reactions. or materially shifted the portfolio, but they have taken advantage of market dislocation to add or to establish new positions in non-cyclical issuers with operating visibility, low leverage, and balance sheet strength. With a spike in equity volatility, attractive option premium opportunities increase, and the fund also took advantage of this situation by increasing its covered call exposure. For this year, the fund is performing as expected, providing downside protection due to its exposure to US high-yield bonds and US convertibles. These asset classes have defensive characteristics that help buffer volatility and limit downside participation when US equities sell off, while providing attractive current income.
Allianz Global Investors.